Imagine waking up one morning and finding out that Ethereum, the world's second largest cryptocurrency, has surged 20% overnight, catching even Wall Street off guard. Major investors are scrambling. Twitter, or X, trends with nothing but the Ethereum logo and rocket emojis. The mainstream news cycle can't keep up. What happened? And, more importantly, who saw it coming? Now, what if I told you that, behind the scenes, an elite group of so-called Ethereum whales are quietly making moves so massive that it could trigger just such a breakout? And that right now, yes, this week, the charts and data are flashing signals that have only appeared before Ethereum's biggest rallies in history. But here's the catch. The headlines are confusing. Some experts warn that the party is over, that new regulations and economic shocks are about to burst the bubble. Others claim the best is yet to come. So, which is it? Is Ethereum about to boom or doom? And how can you spot the real clues before everyone else does? In the next few minutes, we'll dive deep into the truth behind Ethereum's bull and bear tug of war. Who's pulling the strings, what the smart money is doing, and why the answer might shake the foundation of the global digital economy. Let's start at the beginning to understand what's truly at stake. Ethereum isn't just another cryptocurrency. Since launching in 2015, it's evolved into the backbone for decentralized finance, NFTs, and entire digital economies. Unlike Bitcoin, which many treat as digital gold, Ethereum powers entire ecosystems, from gaming to lending, from digital art to global payments. The numbers tell a staggering story. In just the past 30 days, the total value locked in Ethereum smart contracts has soared by 26%, reaching over $132 billion. That's more than 5 times Solana, its closest competitor. Even more jaw-dropping. If you include assets bridged to Ethereum, think of money being funneled across blockchains. That number explodes to over $400 billion. This isn't just theoretical hype. Each dollar locked on Ethereum is capital at work, fueling decentralized banks, lending protocols, insurance products, and next-generation games. The scale is unprecedented, already dwarfing the GDP of many countries. And the trend isn't slowing. In May 2025, Ethereum ETF inflows hit $2.76 billion, with $248 million coming in just the latest week. Major money managers, think BlackRock and the world's biggest funds, are buying Ethereum exposure for their clients. When Wall Street jumps in, it's not for memes, it's for the promise of real returns. Yet with all this momentum, Ethereum's price has been oddly stagnant. As of this week, it trades around $2,545, a figure that barely budges for days, even with all that fresh capital flowing in. It's 7% below its recent monthly high and hovers stubbornly beneath a key psychological barrier, $3,000. So what gives? Is Ethereum stuck in neutral, or is something much bigger brewing under the surface? To answer that, you need to look past the headlines and dive into the data that only the pros are watching. First, the whales, those legendary crypto investors holding tens of thousands of ETH each, are on the move. According to on-chain analytics, whales now control over 103.5 million ETH, up from 102 million just a few weeks ago. That's a surge of nearly 1.5% in holdings, translating to billions of dollars in accumulation. This kind of buying isn't casual. It's deliberate, often carried out in hundreds or even thousands of small transactions to avoid spooking the market. Think of it like a blue whale moving through the ocean. You rarely notice the creature itself, but you see the massive wake it leaves behind. Crypto Rover, a respected analyst, puts it simply: heavy accumulation by Ethereum whales between 10,000 and 100,000 ETH signals strong confidence among major players. In other words, when these titans load up, history says prices often follow, sometimes explosively. But the story isn't one-sided. Digging deeper, the data reveals a war beneath the surface. While some whales are buying, others are quietly selling, sometimes even at a loss. Case in point, Chain flagged a whale recently offloaded 7,000 ETH, about 17 million at a loss. What would drive a major player to exit now? It gets even more complex. Glassnode's analysts point out that a huge concentration of Ethereum investors have their average cost basis, what they paid for their ETH, right around the $2,800 mark, just above current prices. That means if Ethereum climbs, millions of dollars in sell pressure may appear from holders eager to either cut losses or lock in gains. $2,800 could become a battlefield, Glassnode warns. If ETH approaches that level, expect volatility and intense trading. And that's just the price chart. Underneath, mechanics are shifting. Technical analysis shows Ethereum forming a bullish flag pattern, a rare but powerful setup that historically precedes major uptrends. ETH currently trades between the 38.2% and 50% Fibonacci retracement levels, consolidating after a strong rally from April's low of $1,382. Traders are watching for a golden cross when the 50-day moving average crosses above the 200-day average, a classic bullish indicator. If ETH breaks $2,730, analysts say, the next target is the big psychological $3,000 mark, and then, sky's the limit. But just as the digital drums beat, storm clouds gather outside crypto's borders. Global markets are in turmoil. A surprise tariff announcement has reignited trade war fears between superpowers, sending shockwaves through currencies and equities. Inflation refuses to die. Central banks, once forgiving, are turning hawkish, threatening to pull billions in liquidity from the global economy. Bitfinex analysts say it bluntly. The recent price decline is not a breakdown of crypto's market structure, but a macro volatility shock. Inflation, FX tensions, and global liquidity are injecting uncertainty across all assets. In other words, Ethereum isn't moving in a vacuum. Its fortunes are tied to the fate of the broader economy, and that economy is anything but stable. And then there's regulation. The rise of Ethereum ETFs is, paradoxically, both blessing and curse. On one hand, it validates Ethereum as an institutional asset. On the other, it draws the full spotlight of regulators concerned about risks, volatility, and the crypto sector's Wild West reputation. Imagine Ethereum surpassing $3,000, only to have new rules slam the brakes on US or European exchanges, or for central banks to rattle markets with an unexpected rate hike. The specter of intervention is real, and investors know it. Yet, even with all this, many institutional players remain bullish for the long term. Tracy Jin of MEXC sums up the mindset. Most institutions are less concerned about short-term volatility. Their eyes are on Bitcoin's asymmetric upside and long-term value, implying a similar outlook for Ethereum. So, who's right? Are the whale accumulators and ETF enthusiasts about to ignite a new era for Ethereum? Or will macro shocks and regulatory surprises douse the fire before it starts? There's one more wrinkle: Ethereum's place in the competitive landscape. Its ecosystem, while massive, faces pressure from hungry rivals like Solana and Binance Smart Chain, each touting faster and cheaper transactions. If Ethereum can't deliver on speed, scalability, and low fees, will users and developers begin to defect? And finally, what about the risks lurking in the code itself? Security bugs, network overloads, and black swan shocks have sunk promising crypto projects before. Could Ethereum's own strength become its Achilles heel as billions flow in each month? As ETH hovers just below resistance and whales make their moves, the global economy stands at a crossroads. The next few weeks could decide not just the fate of Ethereum, but the future of decentralized finance itself. Are we about to witness Ethereum's greatest bull run since 2021, or is a hidden avalanche of risk about to slam the market back to earth? The answer lies in a delicate balance of whale psychology, technical patterns, macro storms, and regulatory chess moves. Which domino will fall first? In the next section, we'll unravel the dominoes. Who has the power, what history tells us about these turning points, and what you can do to read the signals before the rest of the world. Stay tuned. When we left off, Ethereum stood at a crossroads. The stage was set for a dramatic move, either a lasting breakout fueled by bullish whale accumulation and ETF inflows, or a sudden breakdown under the weight of resistance, market fears, and global macro shocks. The signals are mixed. So, what comes next? Let's peer into the fog, exploring the critical scenarios, the risks that linger, and what this all means for investors poised on the brink. Let's start with the near future, the realm where headlines are written and fortunes are made or lost. There are three main scenarios now orbiting Ethereum's fate. The first, and perhaps the most exciting, is the breakout scenario. If the technicals play out, especially if the price can punch through that critical $1,800 resistance zone, Ethereum could ignite a new wave of momentum. Remember, whales now hold over 103 million ETH, up over 1.5% just since March. That's not small money. It's a silent vote of confidence by those who move markets rather than follow them. Combine this with ETF inflows that have topped $2.7 billion, and you get a massive liquidity injection from both institutional and retail investors alike. Bitfinex analysts point out that recent price drops are more about macro shocks than a collapse in crypto fundamentals. arguing that the structure supporting Ethereum remains intact, even healthy, beneath the surface volatility. A sustained breakout would quickly place $3,000 in the crosshairs, but that's just the opening salvo. A move above $3,000 could trigger a FOMO rally, drawing sidelined capital back in and potentially melting up to $3,500 or even higher, as Ethereum's network effects and dominance in DeFi and NFTs reassert themselves. The bullish scenario thrives on positive ETF flows, confident whales, and a macro environment that doesn't throw another curveball. However, the path upward is littered with hurdles. Glassnode analysts warn that $20,800 is a region dense with investor cost basis, meaning it's where many bought their ETH, often at a loss. As the price approaches, there's a real risk of investors rushing to break even, adding heavy sell pressure exactly when the bulls need momentum most. This is the first potential domino. If buyers can't absorb this wave, the breakout fizzles. Now picture the opposite scenario, the breakdown. Here, mounting sell pressure at $2,800 proves too much. Ethereum whips back below $2,500, and suddenly, the mood shifts. ETF inflows stall or reverse. Whales who have already started distributing quietly accelerate their exits. Remember, even among whales, there's conflict. Some are scooping up ETH, while others are unloading millions at a loss, as Look and Chain reported. This divergence isn't just institutional arbitrage, it's a signal of deep market uncertainty. In this bear scenario, the breakdown can snowball. Long liquidations ripple through derivatives markets, amplifying the fall. Confidence, always fragile in crypto, erodes. Ethereum could see a swift retest of recent lows, $2,300, $2,100, or worse if macro headwinds intensify. Which brings us to the third, wildcard scenario, the sideways high volatility chop. Here, Ethereum gets caught in the crosscurrents. Macro shocks, like trade tariffs, new inflation fears, or sharp moves in global liquidity, play havoc with all risk assets. The price gets trapped between whales accumulating and others selling, ETF flows that sputter in and out, and a market perpetually on edge. Glassnode's cluster analysis shows that cost basis bands are tightly packed between $2,500 and $2,800, reinforcing the view that any move could be quickly faded by the opposite crowd. This scenario isn't just frustrating, it's dangerous. Investors desperate for direction pile into false breakouts or panic on false breakdowns. Chop, like this, can grind accounts down far faster than a straightforward bear market because it constantly tempts you off your plan. The death by 1,000 paper cuts is very real here. So, amidst these swirling possibilities, what are the critical triggers to watch? How can you, as an investor, spot which domino is about to fall and react before the crowd? First, ETF flows. These are the real-time pulse of institutional appetite. When you see steady, accelerating inflows, especially during volatility, that's a sign that big money hasn't lost faith. If inflows dry up or reverse, be wary. It can signal a shift from accumulation to distribution, often before price action makes it obvious. Second, whale wallet behavior. It's essential to dig below the surface. Are the biggest wallets adding to positions, sitting on their hands, or distributing into strength? Tools like Santiment and Look and Chain offer near-live glimpses into whale trends. Look for clusters of consistent buying or selling, not just headline-grabbing single transactions. Remember, smart whales often move just before price inflection points. Third, macroeconomic shocks. Bitfinex's team reminds us that what happens outside crypto often matters even more than what happens within it. Sudden U.S. tariff announcements, sharp FX moves, or liquidity pulls can send even the best technical setups off a cliff. Setting price alerts tied to major macro events, even using traditional financial news, can be a lifesaver here. Fourth, technical structure. Watch the $2,500 support and $2,800 resistance zones like a hawk. If Ethereum closes above $2,800 on high volume, that's your technical green light. If it loses $2,500 decisively, that's the red flag for bears. Don't get caught in the no man's land between, wait for confirmation, then act decisively. But strategy isn't just about watching charts. The real edge, especially in these crowded, uncertain markets, comes from understanding the broader context, the dominoes outside Ethereum's immediate reach. Regulation is looming. In the US and EU, crypto policy is still evolving. One major shift, say a sudden ban on staking products or tighter ETF restrictions, could instantly redraw the landscape. On the other hand, Clear, friendly rules could open the floodgates for institutional adoption. This is why keeping an ear to the ground for regulatory chatter remains crucial. Competition is another silent force. While Ethereum remains the dominant chain in DeFi and NFTs, rivals like Solana and BSC aren't standing still. If they make a major breakthrough, such as solving network congestion or onboarding a wave of new developers, Ethereum's moats could be tested. Sometimes it's not about who wins outright, but who loses less market share. And technology? Ethereum's next scaling upgrade is coming, with promises of lower fees and higher throughput. If the upgrade launches smoothly, confidence could surge. But if bugs, delays, or hacks hit headlines, it could reignite doubts about Ethereum's long-term viability. The secret here: success often doesn't mean perfection, just credible progress that reassures both retail and institutional investors. So, let's get tactical. What can you do right now in this minefield? First, build a decision matrix. Map out your reaction to each potential trigger. If ETF inflows surge and price clears $2,800, maybe you scale in with tight stops. If whale distribution accelerates and $2,500 cracks, you consider hedges, reducing exposure, or even short opportunities for more advanced traders. Second, size your positions. In uncertain times, risk management trumps bravado. Even if you're convinced we're on the verge of a breakout, overcommitting is a recipe for disaster if you're wrong. Legendary trader Paul Tudor Jones famously said, "The secret to being successful from a trading perspective is to have an indefatigable and unquenchable thirst for new information and to always be flexible. Don't get stuck. Be flexible." Third, use layered orders and patience. If Ethereum whipsaws, don't chase candles. Layer entries at key levels and let the market come to you. This isn't a market that rewards impatience or emotional decisions. Fourth, stay informed. Set alerts for major whale transfers, ETF flows, and regulatory headlines. The difference between catching the next move early or becoming exit liquidity often comes down to who reacts to new data faster. And finally, zoom out. Ethereum's long-term story hasn't changed. It's the programmed money layer of a new financial internet. Institutional adoption is only just getting started. Regulatory frameworks will mature. Layer 2 scaling will keep progressing. The journey is messy, but the prize is enormous. So, with all the dominoes lined up, whales, ETFs, resistance levels, global macro, regulations, and competitors, how should we answer the question, will Ethereum break out or break down? The truth is, the next decisive move will be written by the strongest force to appear first, be it a wave of whale accumulation and ETF inflows overpowering resistance, or a cascade of macro shocks and profit-taking dragging the price down. The signs are there, but it's up to each investor to recognize which domino is starting to wobble. If you're looking for a single game-changing secret, remember that the strongest rallies and ugliest crashes both begin with subtle shifts: a sudden spike in ETF inflows, a cluster of whale accumulation, or an unexpected regulatory headline at 3 a.m. The market rewards those who can spot these shifts early, not those who wait for the crowd. So stay vigilant, stay informed, and above all, stay humble. Ethereum's next move may not just decide short-term profits. It could mark the start of a new era for both crypto and the broader financial world. If you found this deep dive valuable, smash that like button, subscribe for more expert-level market breakdowns, and hit the bell to never miss a pivotal update. Drop your take in the comments.